Hey guys, Michael here with Daryl French, and today we're going to be giving you an update on what the mortgages are doing and what's going on with the interest rate. So, Daryl, give us the update.
Lots of fun and excitement. It keeps changing on a weekly basis, depending on what's happening. We had some defaults in the U.S., which has really kind of changed things up in the last couple of weeks. I was talking to Michael earlier, and I said I went away March 3rd on holidays, and the bond yields were at 3.6%. I come back on March 13th, and the bond yields have dropped down to 2.8%. So it gives you an idea of the volatility in the market just over a couple of bank issues, pretty major issues in the U.S. So yeah.
What does that mean for us now with the yield bond changing?
Well, that's the challenge we have is on the Canadian side of the border. Actually, our economy is starting to we're starting to see a lot of really positive signals. Unemployment numbers. GDP numbers, all these things are going really positive on our side of the border. There's some negative stuff still happening in the US. And if you'd heard the Fed chair in the US 2 weeks ago, he'd said that they're expecting 3 to 4 quarter% increases and likely a 0.5% increase this week. So that's a fairly big difference to what we heard the week prior to that from the Canadian side of things, saying we think we're going to hold firm. We think we're at the top and we can hold that.
So just to summarize, so it looks like we are kind of doing pretty well with the inflation, right? Because that's why we're increasing the interest rates.
Yeah.
But our neighbors are not doing that well.
Exactly.
So what does that mean again for us if they're going to continue increasing the interest rates?
That's right. So we're two independent countries, but we're not. So if the U.S. keeps going and moving theirs up, and they do 3 or 4, 2 or 3 quarter% increases, we can only let that gap get to be so much. That is going to pull us along at some point in time. Otherwise, our dollar goes down and it tanks on the other side, and that hurts our economy. So it's a real give and take as the U.S. makes changes and decisions. That does impact Canada as well. So we have to keep our eye on that. But we also have to see what's going on in the Canadian economy. We have to make sure that, is inflation, and especially the core inflation numbers, are they going to continue downwards? If they can continue downwards, then there's a lot less pressure on the mortgage rates in Canada going up. But as I keep saying, I think we're somewhere here on the interest rate cycle. Are we here? Are we here? Are we here? It's really, really hard to tell, and so many influences around the world impact that and can change it overnight.
Absolutely. So what people can do if they, I guess the biggest one, if you have a mortgage that's coming for renewal, if you're thinking of buying or maybe even selling, what are the options? Because there's a lot of options that people have, right?
Yeah.
Like transferable mortgages or assumable mortgages. But what about the renewals? Because I think that there's a lot of people that are very afraid of, if the interest rates will not come down before the renewals, and majority of people are buying houses in the summer. So I think that that's going to be the same for renewals, right? They'll be coming up due probably in the next quarter.
And I think that's a really important question because you look at it, traditionally about 3/4 to 80% of mortgages go into a 5-year fixed rate product, right? So right now that is changing. We're seeing a lot of people looking at 2, 3, 4-year terms, trying to time where they think, once interest rates start to go down, they want to time their renewals to be in the bottom half of that next interest rate cycle, which is really challenging for all the reasons we just explained. So, sitting down and looking at your own situation and looking at and considering 2, 3, 4-year terms, not just looking at a 5-year option. Because if you think about it, I've been doing this for almost 30 years. And usually in a normal market, the most expensive rate, 5-year, 4-year, 3-year, 2-year, 1-year, and then variable rates are the least expensive, lowest cost because they're the highest risk. We're absolutely completely upside down on that right now. So variable rates are actually the most expensive and 5-year rates are the least expensive. So really taking a look and sitting down and discussing with a professional what options are going to suit you the best. I think that's really important today, and not just signing that mortgage renewal, because it can make a huge difference on when you renew over the next few years.
Right. So the benefit always is to talk to a mortgage broker like you, right, to get a second opinion, because you guys have access to more lenders. You're not just dealing with one of them, right? And there's obviously a big difference as we talked about.
And different lenders. So I actually just sent an email off to clients and different lenders. Like one lender might have the best 3-year available. Another lender might have a better 2-year. So it's not as this market is not as cut and dry as we normally see. So it's really important to kind of take a look at your options and shop it around and make sure that you're kind of getting the best you can get.
And if anyone is thinking about or have further questions, or thinking about renewal or figuring out what to do next with their mortgage, what's the best way to reach you?
Give me a call, Daryl French, 250-470-8843, and happy to discuss your options with you.